Hi, everyone. Thank you for joining WisdomTree's Fed Watch, Waiting for Clarity, with Professor Jeremy Siegel, WisdomTree Senior Economist, Jeremy Schwartz, Global Chief Investment Officer, and Kevin Flanagan, our Head of Fixed Income Strategy.
Well, if we were waiting for clarity, I don't know that we got it. Right before we joined, Kevin Flanagan, our Head of Fixed Income Strategy, was referring to this as a ham and rye type meeting. The professor said maybe peanut butter and jelly, but a little bit boring of a meeting. But we'll see, Professor. We know you have some different takes than Powell, so curious what you heard from today and your current read.
Yeah, I mean, it was exactly boring as we all expected it to be. Well, Powell talks a lot to the press, and he's open. And, you know, when he gives something 2 weeks earlier and answers Q&A, and then there's a meeting and there's no real news between those things, he's not going to change his mind. So there's zero surprise. However, but you got to read between the lines. There's two lines that I thought were interesting. One got a round of laughter from the press corps when the press corps asked him about the fiscal policy and his opinion. He said, "We don't give opinions about fiscal policy, and we don't ask them about opinions about monetary policy." I mean, that was like, stay out of our bailiwick. We'll stay out of your bailiwick. You stay out of our bailiwick. I mean, I thought that was a indirect jab at interference is not welcome from the president and the administration into that. So, and definitely that got a rise. I also, more to the point of the economy, he did say, my gut feeling is that the economy, there's a lot of uncertainty. And he said it in a way like, it was the unemployment uncertainty. And he said it in a way that was, yeah, I'm fearful of that sort of outcome. It wasn't like, oh, we have certainly on the two-sided, one is the inflation side, the other is the unemployment. What are we really going to do? As we all know, he changed the first line of the statement to talk about elevated inflation, employment. It's interesting. No one asked him about, well, don't we call that stagflation? Are you going to call it stagflation as a risk? And it was interesting to me. The press didn't pick up on that. Several of the press asked, I forget exactly which one it was, asked a very good question. I mean, we know that the ships coming in from China are way down. The deliveries are way down. We're beginning to see the beginnings of that supply chain, the inevitability of the disruptions of the supply chain. And then he says, well, we don't see it in the real data. Of course you don't see it in the real data. It's going to take a number of weeks to see it in the real data. But, by the time you see it in the real data, it's too late. I would have said, well, if you're going to wait until it comes into the unemployment rate, or maybe the jobless claims, we can talk about those. But, I mean, it's too late. You yourself have said you believe, and of course this was a phrase that was made popular by Professor Milton Friedman, that monetary policy works with long and variable lags. So you can't wait until the ball hits you in your face and say, I'm turning away at that point. Now, why didn't anyone ask him about that? I don't know. If I was there, I would. Waiting for that data is waiting too long. Now, let me talk about the bind that Powell is in. And part of the bind that Powell is in is because monetary policy is being executed incorrectly. What do I mean by this? If you look at historical data on short-term interest rates and long-term interest rates, short rates are much more variable, and long rates are more stable. But under the evolving monetary policy of our Federal Reserve, they keep the short rate much more rigid. It's like the tail wagging the dog. And they let all the uncertainty wag onto the long rate. That's not a good idea. It's not necessarily a disastrous idea because it depends if you move when you have to move. But what am I getting at? The feeling is when they start moving, it's momentous. It means another move. It means a year of moves. No. Why don't they move down 50 basis points? If Trump takes it off, the tariffs, oh, yeah, everything is good, they raise it 50 basis points. Do you think the economy is going to overheat in 4 weeks? That the Fed has it down by 50 basis? No, because, you see, that's not the way people think. It's starting down. Oh, you now made a mistake. Now you're stuck there. Why should you be stuck there? If you go through history, the Fed should be moving rates a lot more. Back in the old days, the Fed funds rate would be jumping up and down. Short-term rates would be jumping up and down. They would sometimes have a 200 basis point movement within a period of a week, depending on the demand and supply of funds and all the rest. But no, now they're fixed rigidly to the basis point. And you don't start movement. So this lowers the flexibility of the Federal Reserve. You see, now they feel, I can't move. If I move, then I have to stop, and then I have to warn, and then it takes 2 or 3 meetings before I can start. I mean, why do you think that way? You got yourself, because you've done it that way, and you got yourself in your own bind, but there's nothing operationally or theoretically. In fact, theoretically, you should not be doing it that way. All right. I've had my piece about the way monetary policy, but this permeates this whole feeling about, okay, I see threats. I see threats to the real economy. I'm going to lower it. If those threats go away, I'll raise it back. I can do that in 2 weeks, 3 weeks, 4. But I don't even have to wait the 8 weeks in between the Fed open market meetings. But no, you see, they're all locked into this way of doing it, and that gives them much less flexibility. So now they're afraid to even move a little bit, even though it's staring them in the face. Now, I've made this point, a week ago Monday. Long-term inflationary expectations are not up. The 5-year forward rates, which extracts the next 5 years out, is not up. It's down. It's down on inflation and on interest rates. It's not getting into long-term expectations. Now, if you listen to him closely at the beginning, Powell did sort of suggest we're not seeing it into longer term. He didn't really talk about 5-year. Maybe he didn't want to confuse the group or whatever. I'm not surprised because I know there are a number of people in the FOMC that listen to me when I'm on CNBC, and someone I'm sure in the 2-day meeting said, oh, by the way, Dr. Siegel mentioned 5-year. Well, what do we think about that? Well, he wasn't asked about it. He didn't say about it. But he made some comments like he was aware of it. All right. I mean, I just want to tell you what my position is, the way the monetary policy should be run under what's called an ample reserve regime. It should be much more flexible. If things look bad, drop it. I mean, and then 2 weeks, 3 weeks later, I don't mean that you watch every single thing. There has to be it, but it's this idea that you start cycles that are months, if not years long, will lock you in, and that sort of thing is one of the things that, of course, lock them into being so unbelievably and irresponsibly late in raising the interest rate when every single indicator was flashing red. I mean, he actually made a little mistake there. He said, yeah, it reminded me of 2021 and 2, when he's talking about, the inflation indicator and the unemployment indicator were moving in different directions. And then he corrected himself. Oh, I guess they were moving in the same direction. Yeah, we had a super tight labor market and inflation was going up and they didn't move. He said, I thought the economy was fragile. When there was nothing about the economy that was fragile. But we could go in. But let's talk a little bit more about, you know, where we are. I mean, I think the Fed would be late if the tariff is not resolved. We'll see what happens this weekend. I think the market. I mean, the market is expecting a real lot of relief, in my opinion. And I hope we get it, but there ain't no guarantee. I say if we come out of Sunday, you know, the Besson China meeting, without something positive, quite positive, I think there would be a negative reaction, because those ships are not coming in. And, you know, even if all the tariffs were taken off tomorrow, there's going to be a supply shock. It's not going to be overly damaging the economy in that short period. And secondly, as I've already said, you know, 10% on the world and 20% on China. Let's say that's the best case scenario. I think Paul Tudor Jones was on CNBC 2 days ago. He said they're going to lower it to 50%. Well, even that's a huge shock. Well, by the way, we just got news, as you probably know, just before we got in, that Trump is taking off some of the AI curbs. I didn't have a chance to read it. Actually, the market popped up. It was about 3:45. Maybe that's a little bit of a carrot to these negotiations to China, saying, listen, you know, we're going to remove this. You know, we made the first move. Let's see what you do here. And market actually really shot up a bit on that. Came back a little bit, but actually shot up on that news. So, I mean, the tariff news is the dominating news. I mean, like what the Fed does or doesn't do, this was expected, is of real secondary importance at this time. I am interested tomorrow morning in the jobless claims. We do know it jumped up 1 week, but in 1 week is, you know, there's too much, you know, volatility historically to say anything about a trend. If it stays, I mean, if it jumps to 350 or 250, 250, 260, you know, that could be the cause of some concern. I'm not saying I expect it to do so. And don't forget, as I mentioned, no one is feeling it yet. I mean, at the ports, they're feeling it, but the goods are there. The people, you know, in fact, there was a buying rush on potentially tariffed goods that's going to juice the, you know, April data and maybe even some of the May data. It takes a while to flow through. So we really don't, you know, I mean, you know, Powell say we're not seeing it. Of course you're not seeing it. You wouldn't expect to see it now. I mean, the only way you would expect to see it now if people say, oh, things are going to be so bad, I'm just laying you off because I expect it to be bad. Now, firms don't usually do it until they really see, oh, my God, I can't sell these, you know, I'm not selling these goods. I can't get the margin. They're not buying at this tariff rate. I've just got to lay you off now because I'm not making my margin. That's usually what happens, especially because unemployment's low. You can't afford to just let people go prospectively for something that just might not happen. So, you know, the fact that we didn't see it in the April jobs report to me meant nothing in terms of what the potential impact of that would be. Well, I've said a lot. Kevin, you want to come on?
Professor, this actually, I think, may help to answer a couple of the questions. So, you know, I mean, you mentioned it. Powell talked about in the press conference, not for the first time, actually, the tension between the two parts of their dual mandate, employment and inflation. And he also said, which I'm sure you must have loved, we can't act preemptively in this situation.
Yeah, I mean, that's what the Fed is supposed to be. Yeah, we can't. That's what you're supposed to do. But again, Kevin, I repeat, it's because they're locked into the way of their doing it. Like, oh, one move in the wrong direction is like fatal. Rather than, okay, we're going to move down because we see some weakness. If it doesn't materialize, you know, we'll go down from 4.3 to 4 or 3.8 or whatever. And if the strength continues, we'll go back up to 4.3.
So the question is,
I mean, no one thinks like this. They think in these broad cycles of going up over years and going down over years. That's not historically what the short-term interest rate is supposed to do.
So, I mean, some of the questions revolved around, so what is it? What finally gets Powell to act? Is it jobs? Is it the labor market, the employment? Is that what finally is going to be?
Yes, it will be, because look, in the past he has spoken about and he did that in the January and the December. Well, it was, I think, a December meeting was Trump was elected then in their December meeting. I mean, he talked about it's a supply shock. And the Fed is not really supposed to act against a supply shock. It could make things worse. So what they should do is, of course, if it gets into long-term expectations, then you may have to act against it. But as I say, the data I'm looking at says no. The 5-year, it's not yet getting into long-term expectations. So therefore, you should do the labor market shock. I mean, he'll look at, by the time the June meeting comes, which will also be the dot plot meeting and everything else, we're going to have a much better idea about where things are, and what happens. I mean, unemployment claims would still probably be first, and the labor market would be second. On the that's a coincidence. The unemployment rate is a lagging indicator, even though that's one of the two mandate indicators of the Federal Reserve. I take a look at the long bond, how long it will sink back towards 4%, with the 2-year really go down well below 3. I mean, saying, on what was it, April 9th or 12th or whatever, when we hit that bottom, we had, for a second, it looked like 5 cuts. Well, we know that's an overestimate because of the negative beta of those instruments. I've talked about that. But nonetheless, you have another test of the lows if you do with no progress. And I'll tell you, if you have no progress, I think you do test those lows on the equity market. That would also be really so. Testing the equity lows, seeing, and you would see the 2-year and 10-year move downward as a result. The inversion of the term structure get worse. The Fed will act under those circumstances. Let's hope it doesn't. Let's hope he unwinds enough. And I said, is the 10% 20? I'm talking about base China. I mean, there's going to be carve-outs to be sure. Can they adapt to that and all that? We would have to see, but that would be minimum. But they're even that. It's crazy because you're doing a tax hike on the tariffs before you do the tax cut. And everyone who knows me, I said from day one he was elected, I said, you go after the tax cut first. Then if you want to do something on tariffs, do it later. But people want to see that tax cut first so that it could offset whatever tariff. We don't have the tax cut. There's still arguing about what it's going to be, what it's not going to be, and how much support. They need all the support, so we can't be afraid. People could have their pet peeves, their exemptions. We may not see, even supposed to be done by May. I don't know. Well, we're going to see it by May or even by the summer. I mean, we'll see. But we know the tariff is going to be, the tariff effect is going to certainly be hitting, I think, before the tax cut is done.
We talked how important China was this weekend. Just overnight, the China Central Bank took all sorts of actions. I don't know if you followed that story,
Yes.
But people are saying they're preparing to give they've been supposedly not doing some of the tariffs, implementing them quietly. You now got this news from Trump, maybe backing up the AI chips. It's like, are they digging in because they know it's going to be challenging? Or, it's interesting that the central bank there is actually taking some measures while the Fed didn't.
Yeah. I mean, yeah, because it is interesting that they're taking measures. Now, let me repeat. I think you're going to, especially, I think you're going to get a repeat of Trump's criticism of Powell. And if the data gets worse, he's going to try to dump all of the blame on Powell. I mean, listen, my tariffs would not have caused a recession if Powell had lowered interest rates like many thought he should, like the term structure said he should, the way the Fed funds future said he should, the way the 2-year said he should. You can be sure that he's going to try to pawn off the blame and I don't mean for Powell to crumble before Trump. That would be horrible too. But if he did lower interest rates for what I think are good reasons to lower interest rates, he really eliminates a lot of that. Then if we have a recession, then Trump can look in the mirror then on who caused that. So I mean, his question. I mean, really, the pressure on the Fed and the survival of its independence, or certainly the degree of its independence, really is not at stake right now. Because basically, he was told to back off on the Fed. That's rallying them. That's upsetting the markets. It's upsetting international. It's causing dollar decline, et cetera, and so on. And as long as he doesn't see a recession, he say, okay, I'll be off the Fed. You watch if he starts seeing signs of a slowdown, a real slowdown, you're going to see that pressure go up exponentially, I think, by the Trump administration onto Powell. And, and then it'll be a battle of wills. Well, I need it'll be a battle of wills rather than what is economically really necessary to do. And by the way, lowering 100 basis points. I recommend. I think Fed funds should be in the low 3s now, not low 4s. But that's not going. If we're going to have a recession from these tariffs, that's not going to prevent it. It's going to ease it a bit, but it wouldn't prevent. It's not a matter of if they lowered 100. No, with these tariffs, there won't be a recession. If there's going to be a recession with these tariffs, in 100 basis points is on the short end ain't going to is not going to do it. It'll ease it, but not going to do it. Jeffrey Gundlach was on, and he was asked about lowering rates in the future, and he said, I think we're going to have some trouble in the credit markets or something like that. I guess, and that you only have when you have a bad recession coming, and that'll force them. Well, let's hope we don't get to that, because, if you have trouble in the credit markets, now there was a big discussion about private credit, which we're not going to have here, but you're going to have a real slowdown when you have, by the time you have trouble in those credit markets.
So Professor Powell mentioned, and I guess in hindsight, that they should have ended QE sooner. Now, what about the other side of that, QT? Any thoughts on them ending?
Well, he is ending QT. QT is minimal right now, right? So I think it's $5 billion a month?
For treasuries, but they're still rolling off their mortgage backs.
They're still rolling off. They want to eliminate all the mortgage backs, but it's still very slow. No, we talked about that before. They've slowed it down dramatically, and they're very sensitive to that. What that minimum is. I can see them stopping that potentially. If banks begin to signal we've got the reserves we want and we don't want you to squeeze that too much higher, but I don't think they're there at this point. And don't forget, when in an ample excess reserve regime, that doesn't create loans. The only thing that can create loans is lowering rates and encouraging borrowing, or not causing people to stop borrowing. So if you want to encourage growth of credit, money and credit, you got to lower rates. The QT or QE will not produce loans in and of itself in an ample reserve regime, because the banks will just put in their reserves and get 4.33%, which is a damn good rate. They're happy with that. That won't create a loan. You can't do any better. So if you lower the rate, that would encourage loan taking by the public and businesses, which would create money by creating demand deposits, which would increase liquidity of the not liquidity of the banking system, but because the banking system doesn't need liquidity. It's for 20 years it's been it has enough liquidity since the great financial crisis. I mean, it's a question of the liquidity of the public sector. As I pointed out, a couple of weeks ago, it's growing, thank goodness, but it's growing at 4% a year, and that's a healthy economy is 5 to 6, and if we go into a recession, that growth rate will slow down a lot because people won't take out loans. They don't take out loans, and then banks don't create deposits, and that's part of the money supply. So, without the Fed doing anything, you would see money growth slow down without lowering the rates to try to encourage people to take out loans and therefore create deposits.
Professor, there was about 3 or 4 questions that came in on stagflation, how you define it, how you look at that. But also Amy writes in about Gunlock on TV was saying that in the short term and long term, inflation wasn't in check. And do you have this view that inflation?
Yeah, he did say that. And I don't, he might have been using a different measure. I actually stepped out for a moment and I came back and I heard a little bit at the end of that. I was looking at the 5-year, which is something the Fed looked at. I think he was looking at the 1 year out to 2, 3, 4, and then he wasn't getting it because these tariffs are going to influence it for more than just a year. But my reading of the 5-year. I mean, if you give me a second, I didn't check it in the last. Let me just 5-year swap inflation rate. I have 2.36%, and that's on the CPI right at this instant, which runs about 30 basis points over the PCE. So if you say subtract 30 basis points, you get 2.06. You can't get any closer. That's the 5-year. Now there is a correlation, that as far as that, but that's the best measure you have. Something the Fed has used. So I don't know what measure Gunlock was saying. Yes, if you use the 10-year tips versus the 10-year nominal, of course you'll see an increase in inflation because you're going to see the inflation from the tariffs. But we want to go beyond that. We know there's going to be inflation from the tariffs. The question is the inflation from the tariffs going to be seeping into the inflation, way further out? And at least on this very important measure, I don't see it. At this moment.
Very good. And for maybe some final comments on equities, there's been some the big rotation a bit this year. Do we think that can continue? How are you thinking about just the general stance on equities?
I think as these tariffs, it's going to be really hard to get back to those February, 19th highs. I see a lot of churn. I see the question is, I even see, right? I think even if you keep 20% on China and 10% on everyone else, you take a look at, first of all, what percent have lowered guidance? Those that gave guidance have given guidance that is mostly a lot lower. In some cases, 1/3 lower United Airlines, General Motors, Ford, a couple of them made explicit estimates. I mean, all you need is 8, 9, 10% lower to have a flat, 245 earnings for the S&P. At that juncture, Now, as time goes on, people will adapt. There might be some, if they make some deals, then there'll be some source of demand abroad. But I mean, there is brand. I mean, there is brand USA harm done by all this. I mean, what was it? Tesla? I don't know. Was Tesla sales down 80% in Europe or some unbelievable number? I forget. It was like incredible. Almost a wipeout. Now part of it is the Dow down. So actually the Dow is down 10%. So part of it is, that is the Dow is down 10%. But that sort of thing takes a long time to wear off. Even if all the tariffs were taken off, there's this sort of shock thing and putting you into that sort of position. People react viscerally to that. You saw what happened in Canada on the election, which the conservatives seemed to have before Trump pretty easily, and didn't work out that way. So, these things have lingering effects. So, my feeling is, now as far as growth versus value, obviously when lower interest rates, that will help the value stocks and the dividend stocks. There's no question, because they have a lot of cushion on paying their dividends, and they want to keep on paying them. And so, if you get the Fed funds down to 3%, then 3% dividend payers are really looking good. When the short-term rate is 4.33, do I think the stock market's going to go up to make a difference on that? Listen, long run, stocks are still great. I mean, tips are 10-year tips are 2%, 20 PE stocks. And long run, it is 20 P's, a 5% real, 2% real. It's a 3% edge. It's still a big edge here on this. So I'm bullish long run. I think there's a lot of expectations on tariffs being dropped, and even if they're being dropped, I still see problems with the 10-20 that will keep earnings down for a while until the firms begin to adapt their supply systems in 2026 or anything. So I'm not looking for a big snapback. I know there's a lot of short positions in there, and I think that if they get some deals, you'll see some sharp snapbacks. But we'll see what happens in China and whether these, this weekend begins to see some negotiations. I think China is prepared to tough it out, even though they've got it and they would move, and we'll see what happens. Still love stocks long run. I'm not selling my positions. Just think that these tariffs are a tax that we did not need at this moment.
We always appreciate getting your insights on markets, the economy, the Fed. Kevin, great to be with you.
Thank you, guys, and we'll talk again.
Take care, everybody.